You wake up, check your phone, and see something strange. While you were asleep, your portfolio earned more money than you did all month at your day job. There was no sudden lottery windfall, no late-night crypto gamble. This happened strictly because a mathematical threshold was crossed. Take David. He's 38 years old. For 14 years, he's scraped together every spare dollar, skipped the expensive vacations, and aggressively fed a boring, standard index fund. He has hit exactly $1 million. And at this precise number, he reaches what financial advisors call the crossover point, the moment his portfolio's passive income permanently replaces the need for his physical labor. This chart shows exactly how the math flips. A $1 million portfolio returning a conservative historical average of 7% generates $70,000 a year. That overtakes the median American salary. That $70,000 is fully automatic. It arrives whether David clocks in, takes a month-long vacation, or never goes back to the office at all. David spent 14 years training himself to take constant, active effort. Every raise and every skipped luxury required a conscious decision to move the needle. But now that the portfolio has taken over, those same proactive instincts are about to become a liability. Financial planners know this line well. It is the boundary where your capital definitively starts outworking your labor. $1 million represents a structural shift in the math of compounding. It introduces a requirement for total inaction that the human brain is rarely prepared to handle. To understand what happens next, look at this formula. It's called the rule of 72. You take the number 72, divide it by your expected annual return, say 7%, and it tells you how many years it takes for your money to double. Here, that's roughly 10 years. Applied to David's timeline, the math becomes highly uncomfortable. Starting with his $1 million at age 38, his portfolio will hit $2 million by age 48, even if he stops saving completely. Leave it alone, and it doubles again to $4 million by age 58. By standard retirement age at 68, he sits on $8 million. His first million took 14 years of aggressive, brutal discipline. The next $7 million requires 30 years of zero effort. Compounding reaches a point where your manual input is mathematically irrelevant. You stop funding the snowball, and the snowball starts funding itself. After 2 decades of conditioning that progress requires constant hustle, the human brain violently rejects the idea of sitting still. The trigger is usually a choppy market. The portfolio temporarily drops from $1 million down to $900,000. Loss aversion kicks in, and the pain of losing that milestone feels twice as intense as the joy of reaching it. Panic sets in. People move their entire balance to a cash savings account to protect it. They try to time the next rally, or they cash out to buy a boat. They kill the compounding engine before it can roll on its own. The discipline of building wealth relies on action. The discipline of keeping it relies on restraint. Savers look at their static accounts, mistake patience for inaction, and confuse holding with losing. As Charlie Munger observed, the big money isn't in the buying or the selling, it's in the waiting. By confusing constant activity with actual progress, successful savers intervene at the exact moment their money starts working for them. They sabotage the machine. Below $1 million, inflation slowly eats your savings. But at 7 figures, your relationship with inflation reverses. It stops being a predator and becomes a harmless background metric. Looking at this chart of historical averages, the market generates a 10% gross return. Even when a 3% inflation hit is sliced off the top, it leaves a net 7% real growth. The portfolio absorbs the cost of living increases and continues to outpace them. Then there is the tax code. Long-term capital gains in America max out around 20%. Wage income can top out near 37%. Passive gains are taxed at roughly half the rate of active labor. Crossing the $1 million mark is the threshold where the financial system stops taking a premium on your labor and begins aggressively protecting your capital. The paradox is unavoidable. Hustle gets you to the first million. Absolute restraint is the only thing that keeps you there. Look at Warren Buffett. The wealthiest individuals intentionally make the fewest changes to their portfolios in any given year. Automatic wealth isn't loud. It involves zero day trading, zero hot stock tips, and intentionally stepping away from the spreadsheet. The crossover point grants the ultimate form of leverage. It buys the permanent right to say no to mandatory labor, toxic workplaces, or forced overtime. Surviving this milestone requires you to stop working for your money. You have to let go of the hustle, sit quietly, and let your capital buy back the rest of your life.